Robert Pryor joins in from Credit Suisse to talk more about this rating, or rather the outlook downgrade. Robert, hi, afternoon. Surprised to see the downgrade coming in India, or rather the outlook downgrade coming in, considering if someone was watching how the bond market as well as the yields were shaping up and the currency weakening day in and day out, this was pretty likely.
Yes, I think it's right, although I don't think the weakness that we've seen in bonds and currencies has a huge amount to do with this directly. I mean, I guess the way I would see it is that the bond and currencies are reacting to fundamentals that that are generally not particularly encouraging, particularly on the sort of structural reform front. One thing I would also just clarify here, there's a lot of talk about this 5.3% number, that this is 5.3% per capita real growth. Now, because India's population is growing, I don't know, by 1.5% a year or so, that's still consistent with about 7% or so growth, as I understand it anyway. So they're not actually, that 5.3% number is a little bit misleading in that sense. But, it reflects a frustration with the lack of reform. It reflects a frustration probably with the budget announcement as well. And I think a lot of people share that frustration.
Robert, but what about the fact that S&P has outlined that there is a 1 in 3 possibility of a rating downgrade? Would that worry you?
Well, 1 in 3 is not ridiculously high, and that's within the next 24 months as well. So, I mean, what I would hope to see is, of course, is the government reacting to this and taking heed of this advice, and of course advice that a lot of people are giving at the moment. No doubt the government knows roughly what it should be doing. I guess the point is, can it do it? I think the government wouldn't need to do a huge amount to pacify the rating agencies. I think what we will need to see is an increase in subsidised fuel prices. I think they would also like to see this GST and the tax codes, direct tax code changes implemented. I think all of those things will happen. I would be more dubious about the reform in terms of the multi-brand retailing issue, but that's not necessarily essential. I think we mainly just need bits and pieces. The other point I'd make here is that, they did comment about India's high level of deficit and debt. Yes, clearly the deficit is very high, but what should be borne in mind is that India's government debt to GDP ratio is tumbling at the moment. It's fallen 15 percentage points of GDP over the last 7 or 8 years, from 80% to 65%. And even with this level of the budget deficit is consistent with a fall in the debt GDP ratio, purely because GDP growth is so strong in India relative to its debt interest cost.
Robert, so how serious do you think is the threat of fiscal slippages in India, and what are your expectations when it comes to the GDP? Do you think a 5.3% GDP per capita outlook is really pessimistic?
Well, as I say, remember this is per capita, and because the number of heads in India are growing, that doesn't mean 5.3 in the way, in the normal sort of way. That would equate, as I say, to probably 7% plus growth. I mean, it's very unusual for the rating agencies to have a number that is hugely different from the consensus. So I think if you were to ask them what is their overall GDP growth number, it would be around 7 to 7.5%. I think in terms of the fiscal slippage question, yes, I mean, I think there is clearly a short-term danger of that, largely because I just think growth is going to be below trends, and that will be adding to spending, and it will be detracting from revenues for somewhat longer. But I think really what these agencies are looking at, given they're taking clearly quite a long time horizon here, is whether we get these structural changes, whether we get this 2% subsidy cap implemented through subsidised price increases, whether we get GST and direct tax code implemented. Those kind of things I think is going to be crucial to whether there is actually a formal downgrade. My guess is that it will be avoided.
Okay, key is to get some structural changes going. Robert Pryor, thank you so much for taking the time out and joining us for that quick telephonic chat. Let's get to another perspective, this time around from Siddharth Sanyal, Chief India Economist at Barclays Bank, who joins us on the phone line from Mumbai. Siddharth, thanks for joining with us. First up, your reactions to this change in the rating outlook of S&P. Did it take you by surprise?
Yes, to some extent, yes. Because though there had been quite a bit of macro headwinds existing in case of India for quite a while, but at the same time, the current grade where India is now is almost the lowest end of the investment grade. So there should not be much of a speculation, given India's macro fundamentals, that it should slip below that. So that way, moving to the negative outlook surprises me a bit.
Tata, what about the currency? Because we've seen the rupee get dampened a fair bit. Where do you think the currency would settle in the near term?
Well, the currency is facing multiple headwinds. This is also not helping. But having said that, I think that the market will be seeing 2-3 factors. That the first factor is this is ultimately a change in outlook, and ultimately the final rating will most probably not be changed, number one. And what will be important is how the equity market and the FII flows react to that. I know some amount of FII flows will be very, very rule-bound, and if there is a change in rating, they would have to exit. So those are the areas of worry. But otherwise, I don't think this will change things dramatically and fundamentally, because my sense is that will still factor in no ultimate rating downgrade for India in the coming months.
All right, Siddharth, we'll leave it at that. Thanks for that quick perspective.
Yeah.
Get you another review from Arnab Das, MD of Rubini Global Economics, who joins us on the phone line live from London. Arnab, thanks so much for joining us on the phone line. Your first reactions to this rating outlook revision, do you think it's something dramatic, and do you see it impacting FII flows into India?
Well, I think in a way S&P is responding to an existing deterioration in the outlook for India, which is already being reflected and will continue to be reflected, maybe get something of a negative boost from the potential for downgrade in capital flows, right? I mean, the story is that reforms have stalled, fiscal adjustment is perhaps inadequate, the current account deficit has widened, and the economy has slowed. And there's a more general problem of governance that underlies all of these issues. And you know, I think stating these things is important. It's kind of obvious that all of these negatives have been taking place for some time.
S&P is clearly concerned on fiscal consolidation. So fuel prices and a hike in that is one of the solutions. But if fuel prices are hiked, inflationary expectations will rise substantially. In that case, it is somewhat of a catch-22 situation for policymakers, as GDP growth is already hit due to high interest rates. What is your take on that?
Yeah, I would broadly agree. I mean, I think reducing the subsidies that permeate the budget, increasing the price of petroleum products, it's going to the short-term effect of that is almost certainly going to be to increase inflation, maybe inflation expectations. The longer-term effect is that it's a dampener on economic growth, which may well have the effect of requiring further budget cuts elsewhere. I think the bigger picture here is that the politics of the reform process are extremely complicated, and much needs to be done. Given that the shine is coming off India, the shine generally is coming off emerging markets around the world, and we are starting to go into another phase of the post-crisis environment in which deleveraging is going to come throughout the Western world. It's inevitably going to have an impact on capital flows to emerging markets. Eurozone banks are going to reduce their flows, are reducing their flows to emerging markets, including India. Capital markets flows will substitute to that to some degree. However, India has a widening current account deficit, which is substantially financed by quote-unquote hot money. FDI remains reasonably high, but small compared to any other countries. So the onus on India to deliver a combination of fiscal adjustment that is cyclical and short-term, tighter management of the budget, that is structural fiscal reform and structural economic reform, all of these things are going up.
none of this is to say that the situation is dire. It is just that at the margin things are getting meaningfully worse. And I agree with you. There is a catch-22 element to this. The Reserve Bank has just cut interest rates, which would help to some degree, but there are other pressures that are structural, that require political response and fiscal response.
And a quick final word, given the fact that there's very little forward movement that's likely to happen on reforms, what's your sense? Do you think a rating downgrade is also on the cards now?
There's a significant chance, obviously, given the negative outlook, that the rating will be downgraded. Like I was saying before, the finance minister's comments, the rating downgrade itself may not have that much impact. I think it is more a question of signal here, because of course there's the risk that the rating crosses back from the investment grade threshold to the quote-unquote junk threshold. And more generally, the situation around the world is coming to a point where India, among major emerging market countries, is leading a global slowdown, a deceleration. Maybe not a crisis, but in response to the ongoing crisis in the Eurozone and elsewhere, and in response to domestic economic challenges within many major emerging market countries, we have a more pronounced slowdown now in emerging markets. So some of the hype, the overhype, I would say, is coming off, and that is going to have an effect on capital flows, and it's going to further slow down countries that are importers of capital with current account and trade deficits like India. So like I say, I think the important thing here is the pressure and the onus to rejuvenate the reform process and to kind of restore the shine and incredible India and all these slogans, that is becoming more important than ever. And we would like to see more action on these fronts. We're concerned that we're not going to see much because of the politics.
Let's also get Nirmal Jain of India Infoline. Nirmal, just a short while ago, you had the equity markets which really cracked on the back of the news that S&P has revised India's outlook to negative from stable, and pretty startling revelations saying that it's expecting India's real GDP per capita at 5.3% in FY13. How would you react to this?
I think it's a wake-up call, because country's fiscal deficit and balance of payment current account deficit both have been going out of control. And see, what this means is that S&P will review it in 6 to 9 months. And if the things worsen on current account or fiscal front, then they can downgrade. And if they downgrade, then India becomes, the rating will, as of now, is just one notch above junk. And if it becomes junk, then there'll be a problem even with, or the cost will be very high for sovereign bonds also, which is one possibility to bridge the current account gap. And it'll also increase the cost of, foreign borrowings for corporates as well. And what this means is that there'll be more pressure on currency, and therefore even equity investors would like to wait and watch. So I think it is high time that government puts its house in order in terms of fiscal as well as current account, and they need to take some resolute steps towards increasing petrol price, diesel price, which is obvious one, but that may not be adequate. And everybody knows that coalition government has not been able to do much, but now the macro things are worsening to a level that I think this is more like a wake-up call. If they can get it right in the next 6 months, it's fine, but if it really downgrades, then obviously it's not a positive thing.
Right now, Nirmal, one of the points that S&P has made is that there is still a 1 in 3 chance of India's sovereign rating being downgraded, which essentially would make us non-investment grade. Do you see that happening?
It's very difficult, because the normal process, whatever at least I know, is that the review will happen in 6 to 9 months, and by then, if things improve, and things can improve on, even if you are fortunate and say crude oil prices go down, then also our, both current and fiscal account deficit come under control, 1. 2, if government is able to move some of the reforms which, and demonstrate that, they are taking some steps and things. So I think it'll depend on a number of factors, and some of them external, and some of them internal. I think it's very early to, jump to any conclusion either way, whether we'll be downgraded or not. But one thing is for sure, that there's a wake-up call for our government, and now they need to take some steps. They have not been able to increase even petrol prices. So diesel, one can say that there's a populist pressure, but even petrol prices, they haven't done much, and the subsidy burden is widening every day. So I think our macro things are worsening. Currency is under tremendous threat, and these things are obviously not good.